is still a probability of new lows, but I think on balance, like 60% probability that the lows are in of growth tech and the lows are in of crypto. Of the rest of the markets like the S&P, I don't think so. I think we've probably got another leg lower to come, but crypto and tech will outperform. So what I try and do is step back from all the narratives, right? It's a very narrative-driven world these days, and everybody's pushing a different narrative based on their own perspectives, which is fine because these are all probabilistic outcomes and stuff we can't know until things have happened. So I try and step back and apply my business cycle framework and my secular framework to what's going on right now. So the secular framework remains to me that debt, demographics, globalization, and technology are deflationary over time. Doesn't mean we can't have cyclical inflation. Now, the question the market's struggling with right now is this a change in the inflation backdrop? Is the rate of change of prices going to continue? Doesn't mean the prices stay the same. People get confused with this. They think, well, if oil's at $100, that's inflationary. No, it's only inflation if it goes back to $200. You know, it has to keep going up. So the question is do we have those conditions in place with all that we know? So what is the predominant driver of inflation? The predominant driver of inflation has been, in my view, the restricted supply of both commodities and other goods and services because of COVID. And that's still working its way through the system. So we can't know yet what we're left with. You know, what does the world look like? So on a probabilistic framework, I defer to my long-term secular framework of deflation. So, okay, so then what drives inflation up and down in a cycle, in the business cycle, which is the shorter term element? And those tend to last, 2 to 8 years on the upside and 18 months on the downside, generally speaking. What usually drives that is the tightness or looseness of monetary conditions. Now, everybody's focused on the Fed right now. What are the Fed going to do? Now, the bond market priced this in ages ago. So the bond market's already said, 2-year rates are, kind of 3% and 10-year rates are about 3%. The yield curve's been inverted, saying we've got a recession coming, so monetary conditions are going to get too tight. But when I put together a bunch of indicators about what real monetary conditions are, because it's not just interest rates, you've got to think about the rise in the dollar as also monetary conditions. So the higher the dollar goes, the tighter financial conditions are globally because there's less dollars around. And additionally, the rise in commodity prices takes purchasing power away from both companies and individuals. So when you add those three together, the year-on-year rate of change is pretty close to being unprecedented. And it prices the ISM, the Institute of Supply Management Survey, which is the best guide to the business cycle because it's monthly data as opposed to GDP, which is quarterly and gets kind of readjusted later, suggests that the ISM is going to fall from where we are now, 50-something, to something like 35. Now, 35 implies like a negative 3% GDP. So it's a decent sharp recession because of what's happened. It's kind of baked into the cake, and we're starting to see economic indicators suggest the same. Now, inflation is a lagging indicator. Employment is the other lagging indicator. Now, when I look at inflation itself, all the commodity prices have come off their highs. Oil is still the one that's priced higher in terms of where the ISM is. The year-on-year rate of change of most assets actually correlates really well with the ISM, whether it's the S&P, whether it's the NASDAQ, whether it's high-yield bond spreads, or whether it's bond yields. So we found that oil itself is relatively highly priced. So therefore, if the ISM comes lower, which I think it moved shockingly lower very fast in the next couple of months to down 45, suggesting we're in a recession already, then usually inflation over time follows it. So the forward-looking indicators of inflation will start coming off quite sharply and bond yields will start to rally. So I'm waiting for that. I think bond yields have topped, but I need to see those conditions in place. And I think it's only when people start realizing that growth is going to fall. So I think we're in recession. I think it's going to be sharp and pretty nasty, a little bit like 1974. The situation, the current macro backdrop actually reminds me a lot of 1947, which is going quite a lot back in time. But why does 1947? Why is there similarities there? Because back in 1947, World War II had finished, there was no supply chains, and everybody came back into the civilian labour force, very much like a pandemic, but on an even larger global scale. And that caused a massive increase in prices, which then, 18 months later, went from negative 6% inflation, then back up again to like 7%, and then back down to negative, and oscillated in this kind of volatile environment as the world grappled with kind of readjusting to the new world. I think that's probably likely to happen this time around. But for that final thing to happen, considering all commodity prices have fallen, is oil probably needs to come lower and stay lower. And I understand the oil market is very tight. So inflation to me from the commodity perspective, looks like it's coming. Wages lag, but we're already seeing layoffs. We're seeing all the tech companies laying people off, and I think we'll see a broader base layoff structure coming, and unemployment will rise somewhat as well, and that takes down the wage pressure, because don't forget, everybody was bidding for engineers or marketing people or whatever, and a lot of that froth is going to come out. So that will ease, I think, the pricing pressure. The final big component is housing. We're starting to see house prices falling and sentiment falling, and the owner's equivalent rent, which is quite a large part of CPI, should generally trend down over time too. Mortgage rates are starting to fall, but we need bond yields to fall with them. So I think we're in this macro turning point right here, right now, where suddenly we go from inflation fears to growth fears, and that'll be confirmed by bond yields falling. Now, what's really interesting is when we step back and look at the asset markets, most asset markets are pricing in different degrees of this. As I said, bonds and oil aren't really pricing it in. Bonds are the most mispriced right now because of this inflation narrative that's so structural right now. Things like the NASDAQ and tech stocks have priced in the most. So, growth end of tech, stuff like ARK, is pricing in, let's say, an ISM of about 39. So that's pricing in pretty much a full deep recession. So there's a lot of indicators to suggest some of this stuff is getting overdone, not probably completed yet. There's probably another down leg, but also that the economic trough probably gets reached sometime around March of next year before we start recovering. But markets discount on a forward basis somewhat of this, not all of it yet. So how does that affect also crypto markets? Well, the macro driver of crypto is two things. One is the central bank balance sheets. If they're expanding, crypto is generally doing well. Now, currently they're contracting, but we're starting to see signs of changes. It's still early days yet, but I expect the central banks to stop trying to tighten their balance sheets and eventually move to loosening as the recession becomes more apparent and the inflation fears recede. The other macro factor that drives crypto is the money supply growth, global M2. Global M2 has been shrinking, and that has taken away the steam from the crypto markets, and it follows it broadly. It's not a perfect fit, but it's a pretty good fit. So basically, you need to see money supply growing. Now, what's good is we've got forward-looking indicators to tell us about money supply, and it's actually the inverse of ISM. So what it's telling us is going forward, the probability is the money supply globally starts increasing, and we're already seeing the signs of that in China, where Chinese M2 is coming up, and I think we'll see it elsewhere as, for example, the European banks start to struggle a bit, and so money supply starts increasing. So I think we're at the macro inflection point. I think bond yields fall over the next, we'll look back in 2 months' time, and bond yields will have broken 275, which is the floor, I think, in 10 years, and be heading down to 2%. That's very similar to what happened in 2018. The bond market, the Eurodollar market, the short end of the curve is already pricing in rate cuts for January. So the market said, you're going too far here. The yield curve is inverted, but the whole trade sets up as soon as the yield curve starts steepening, which is generally when the bond market starts rallying. So there's a lot of information there, but generally the big view is we're at the cusp of the turn. I think that's what the crypto markets are picking up. The crypto markets are very forward-looking. The tech stocks, the growth end of tech, those things bottomed 2 months ago as well. And I think that's telling us something, is that there is still a probability of new lows. And But I think on balance, like 60% probability that the lows are in of growth tech and the lows are in of crypto. Of the rest of the markets like the S&P, I don't think so. I think we've probably got another leg lower to come, but crypto and tech will outperform. So that's my view in a nutshell.